Hi, this is Ashley Swartz, CEO and founder of Furious Minds. Check me out at ashley@furious-minds.com if you have some comments. So I was reading the news this week, catching up, and I had this moment where I was sort of contemplating whether or not we've reached a tipping point of tonnage in online video, right? So I was reading about Google's NewFront presentation and the fact that they've sort of adopted the norms of the upfronts where they brought in some artists, some sizzle, it's all about content, right? Sex sells, and they're really trying to shift from geek to chic in as far as what they're doing and leveraging content as a tentpole as to what their offering is. You know, they're no longer just a pure play tech or search company. When I went into the agency world, into the media buying side world in 2009, you know, I remember Google being very, very clear and not mincing words that they were not a content provider. They were a platform, right? And today, based on what we're seeing from them and their NewFront presentation, is that they're very much so a distributor and a content provider. So they're subsidizing content. They've created channels. They're distributing it. And more, they're becoming a programmer, which questions what their role is in the ecosystem and how that relates with an online video and more specifically the impact it will have on television. So they announced that sort of on a monthly basis, they've got over 1 billion uniques, right? And that's obviously worldwide. And they're seeing a 50% increase year over year in time spent watching videos for each of those uniques. And what I was wondering is, you know, is this the result of quality content? Is this the result of YouTube sort of, you know, and Google raising the bar and commissioning and investing in premium content? Or is it just sort of the increasing video appetite that we as audiences are voraciously consuming more video? We're maybe reading less online and really looking at sight, sound, and motion as the way that we entertain ourselves. If we've cut the cord, or just because we're a cord never generation? Not sure, right? I do think that a big part of this is driven by mobile if you look at the most recent stats, right? And as the result of Google getting into sort of understanding this and seeing these numbers, they're getting more aggressive about their monetization, meaning specifically, they're dropping the price points for entry, right? They're lowering their minimum requirements for spend to be on YouTube, and they're allowing sort of a greater level of approachability and investment as far as how to actually get on YouTube as an advertiser and engage around their premium content with audiences. So it's not just that YouTube is reaching sort of a change point or an inflection point, right? In general, the entire industry, I think, is poised to see an inflection point in the very near future in regards to the value of video, right? eMarketer estimates that mobile online video will account for 13% of digital spend in 2013, or about $525 million. That's a substantial increase year over year, and given the exponential rate of growth, it's going to continue to increase based on how much audiences are continually spending time on mobile consuming content. According to ComScore, 178 million Americans watched 33 billion videos in February alone, right? And that resulted in a total of about 9.9 billion video ads viewed, which the plurality of that was actually dominated by YouTube based on the numbers that we've seen. So the frequency of the ads and the duration is kind of all over the board. If you look at Hulu's stats, they have an incredible high frequency of like an average of 61.3 ads viewed per unique. And then sort of the other 5 networks are all over the board with a pretty broad range. The reality is that based on this incredible diversity in the number of ad time spent on each video ad network, the frequency of the ads served, the number of uniques, no one's cracked the nut on what the right format is to monetize video. And I think, you know, Google's going to start offering subscriptions, which was their big announcement in the NewFronts, right? So about $1.99, you're going to be able to subscribe to premium channels, most likely a lot of them which they've underwritten, and they're seeing performances and audiences, but likely there's still going to be a presence of advertising there, right? We don't know how that's going to play, because typically the value equation is that if you pay, you don't have to watch ads, and vice versa. And we haven't really figured out what the middle ground is, and I don't think that anybody has cracked the nut on what that sweet spot is as to the level of tolerance and to a ratio of a price point versus the content consumed. So, you know, I have a couple questions, right? And I suggest this is where the conversation should go next. So at what point does online video, meaning in volume, max out in value because there's too much liquidity in the marketplace, right? We've talked a long while, which is why the large media companies like AOL, Yahoo, and Microsoft very early doubled down on video, because there was a shortage of premium content and there was a shortage of super premium content because major broadcasters were slow to take their television content and actually deliver it through other IP-based channels. That's not the case anymore. Based on these numbers and how much players like Google with a ton of cash, and now MSOs are starting to invest in and greenlight original content along with the Netflixes and Amazons of the world, there's not going to be a shortage anymore, right? There may be more players trying different business models, which are just not really that different because they're just subscription versus advertising subsidized, and maybe something in the middle. No one's really driving a different engagement model or trying to figure out how to derive revenue from online video in a very new or divergent way. So where's the innovation? New ad formats, products, new ways to take it to market, new consumer value propositions, and currencies of value exchange need to be developed. And at the end of the day, I think the biggest question we need to pose is, what does this all mean for TV? Media companies and programmers are scrambling to figure out how to monetize online video and what actually the opportunity is there as far as revenue, because the bread is still buttered by their carriage agreements. I think that, again, this is a rally cry for the industry. We've got to sit down, talk together, talk about measurement, and talk about how we plan and buy against that which we measure as success for the online video that we serve and the television. It's going to get us all to a better place. I welcome comments. Thanks. Bye.